Hey there, fellow traders. Welcome back to ChartsEmpire Trading Institute, the go-to destination for all things about trading. In the language of trading, one word stands out: candlesticks. Originating from Japan over 3 centuries ago, candlesticks form a critical part of any trader's vocabulary. Today, we will delve into the world of Japanese candlesticks, their formation, and their importance in the technical analysis of trading. Whether you are a seasoned trader or just starting, understanding candlesticks is like having a secret decoder for the language of the market. Stick around because by the end of this video, you will be decoding candlestick patterns like a pro. But before we dive straight into the tutorial, you must hit that subscribe button and ring the notification bell if you are new to the channel, so as not to miss upcoming and valuable tutorials on this channel. Now, let's shed some light on reading the Japanese candlesticks. What are candlesticks? Imagine a single candlestick. It is not just a simple line, but a block of information. Each candlestick represents a specific trading period. It could be a day, an hour, or even a minute, depending on the trader's preference. At the core of each candlestick are 4 key elements: the opening price, the closing price, the highest price, and the lowest price within that period. These elements come together to form the body and the wicks of the candlesticks. A candlestick begins its life at the opening price. From there, it stretches out to the highest and lowest prices reached during the trading period, forming the wicks. Finally, it closes at the closing price, completing the body. While similar in appearance to the bar chart, each candlestick represents 4 important pieces of information for that particular candlestick. Open and close is the tick body, and high and low is the candle wick. Therefore, the candlesticks served as the alphabets of the market, and their combinations are just like words. When words are combined, they form a sentence. In trading, these sentences are referred to as price actions. Therefore, the market will communicate to us through the formation of these price actions on the trading chart. The inability of you as a trader to interpret these candlesticks can lead to financial losses and frustrations in trading. The market is always in motion. This motion is called price action. These price actions are caused by 2 market participants, which are the buyers and the sellers. The upward movement of price is the buyers and is referred to as bull move or bullish swing, whereas the downward movement of price is the sellers and is referred to as a bear move or bearish swing. Bullish candlesticks are usually represented in green, whereas bearish candlesticks are usually represented in red, but traders can choose any color of choice to represent these candlesticks on the price chart. I prefer the bullish candlestick on my price chart to be green and the bearish candlestick to be red, but sometimes I might prefer blue color for the bullish candlesticks. You can modify the color of your candlestick on most trading platforms by just right-clicking on the price chart and moving your cursor to select settings. You can modify the color of the body, borders, and wicks. Do not worry for now if you don't understand what body, borders, and wicks are all about. We will delve into more detail in the next section of this tutorial. Make sure to hit that like and share button if you enjoyed this video, and don't forget to subscribe for more. On the MetaTrader trading platform, right-click on the price chart and select properties. You will see the option to modify bar up, bar down, bull candle, and bear candle. I have a full tutorial video on how to customize different trading platforms, MetaTrader, TradingView, and others. For more information on how to customize your trading charts, refer to the description of this video. Let's delve into the anatomy of the bullish candlesticks. The candlestick on the left is the bullish candlesticks, whereas the candlestick on the right is the bearish candlestick. First, let's deal with the bullish candlestick on the left side. This is the upper shadow or upper wick. Generally, it is called the high. This is the close, the body, the open, the lower shadow or lower wick. Generally, it is called the low. Because the close is higher than the open, this is why it is called a bullish candlestick. Now, let's delve into the psychological analysis of the bullish candlestick. As we can see, the market opened at a price level on the chart. The bears step in and push the price down from the opening price level. Suddenly, the bulls step in aggressively and push prices higher than the bears during the market trading activity. After the price got to a certain higher price level in the market, the bears step in to exercise some downward forces to push the price down. At the end of the battle between the bulls and the bears failed to push the price to the initial opening level of the candlestick. This action is what led to the formation of the bullish candlesticks on the trading charts in whichever market we trade or analyze. Now, let's search for examples of bullish candlestick in action on the trading chart. As we can see on this price chart, the market was forming continuous bearish candlestick. When the market got to this low, the next candlestick closed up above its opening price level to be a bullish candlestick, and the market turned to a rising price chart. We can see how the price action resulted in a continuous bullish candlesticks. Make sure to hit that like and share button if you enjoyed this video, and don't forget to subscribe for more. Now that you know how the bullish candlestick is formed on the trading chart, it's time we proceed to the bearish candlestick. Anatomy of the bearish candlestick. Here is the anatomy of the bearish candlestick. This is the upper shadow or upper wick. Generally, it is called the high. This is the open, the body, the close, the lower shadow or lower wick. Generally, it is called the low. Because the close is lower than the open, this is why it is called a bearish candlestick. Now, let's delve into the psychological analysis of the bearish candlestick. The market opened at a price level on the chart. The bulls stepped in and pushed the price up from the opening price level. Suddenly, the bears stepped in aggressively and pushed prices lower than the bulls during the market trading activity. After the price got to a certain lower price level in the market, the bulls stepped in to exercise some upward forces to push the price upward. At the end of the battle between the bulls and the bulls failed to push the price to the initial opening level of the candlestick. This is what led to the formation of the bearish candlestick on the trading chart in whichever market we trade or analyze. Now, let's search for examples of bearish candlesticks in action on the trading chart. As we can see on this rising price chart, the market was forming continuous bullish candlesticks. When the market got to this peak, the next candlestick closed down below its opening price level to be a bearish candlestick, and the market turned to a falling price chart. We can see how the price action resulted in continuous bearish candlesticks. I am glad you now have an in-depth understanding of what brought about the bullish and bearish candlesticks that form on the trading chart. But there is still more to learn apart from the bullish and bearish candlesticks. For instance, a pattern known as doji represents indecision in the market and could suggest a potential change in market direction. These are the candlesticks that show a state of equilibrium in price action or a state of indecision whenever they form on the trading chart. Neither the buyers nor sellers were able to move the market on that particular candlestick formation. We will discuss them in the next section of this tutorial. Now, imagine hundreds, thousands of candlesticks, each telling their own story, yet together weaving a larger narrative of market trends and potential future movements. This is the beauty of the Japanese candlesticks. So, the next time you come across a Japanese candlestick chart, remember, it is not just a jumble of lines and shapes. It is a story of the market waiting to be read. So yeah, that is that. We are done with this tutorial, and the good news is we are gonna make another tutorial video. So feel free to suggest the next topic to be treated in the comments section. Take note, before your suggestion can be considered, you must be a subscriber of this channel. So make sure you hit that subscribe button and notification icon. Like and share this video to help other traders. To proceed to the next class, click on the suggestion box or tap on the tutorial links in the description of this video. See you in the next one. Peace.